This is Nightly Business Report with Sue Herrera and Bill Griffin.
Long pause. The Federal Reserve signals it won't raise interest rates anytime soon, shifting its stance on monetary policy as we enter the new year.
Blow to Boeing. The FAA chief says he will not allow the 737 MAX to resume flying this year as lawmakers demand changes at the agency.
Cash is king, and for the marijuana business, it is everything. But there may be a solution to the industry's unique problem. Those stories and more tonight on Nightly Business Report for Wednesday, December 11th. Good evening, everyone, and welcome. The economy is looking good. So for now, it seems that the Federal Reserve is going to sit back and wait for any signs of inflation before it makes a move on interest rates. That was the takeaway from the central bank's two-day policy meeting, where interest rates were left unchanged. Today's decision, or perhaps better said non-decision, follows 3 rate cuts this year, which was an about-face from the 4 interest rate hikes in 2018. Steve Leisman reports tonight from the Federal Reserve in Washington.
The Federal Reserve ended a momentous year for monetary policy by launching what it indicated was a new regime, one where its policy rate is likely on hold for what could be many months. The move to neutral follows 3 successive rate cuts that began in August and a reversal of plans in 2018 to hike rates in 2019. Now, in the policy statement following the December meeting, the Fed called its current stance of policy, quote, appropriate. The Fed's overnight lending rate now stands in a range of 1.5% to 1.75%, and Fed Chairman Jerome Powell suggested that could be the case for a while to come.
We believe that the current stance of monetary policy will support sustained growth, a strong labor market, and inflation near our symmetric 2% objective. As long as incoming information about the economy remains broadly consistent with this outlook, the current stance of monetary policy likely will remain appropriate.
The statement said the Fed is monitoring global developments. That means it has its eye on the trade war and foreign economic weakness in both China and Europe as well as elsewhere. While the chairman didn't rule out future rate cuts, he suggested the bar for hiking rates is high, as in high inflation.
In order to move rates up, I would want to see inflation that's persistent and that's significant. A significant move up in inflation that's also persistent before raising rates to address inflation concerns.
Powell said policy is not on a preset course, but one sign that rates could be on hold for a while, 13 of 17 members of the Fed forecast no change in rates for next year. Those forecasts can change and end up wrong, but for now, the Fed is telling markets the rate now is the rate that it's going to be in 2020. For Nightly Business Report, I'm Steve Leisman in Washington.
And joining us to talk more about all of this, we welcome back Sarah Bloom Raskin, and of course, a former Fed governor. She is currently Rubenstein Fellow at Duke University. Governor Raskin, good to see you again. Welcome back.
Thank you.
So, any surprises for you? Is current Fed policy appropriate in your view?
So the Fed did what I think markets expected it to do, which was to stay firm and to not make any big change. This, of course, follows a number of moves that brought the Fed funds rate down after the Fed, of course, had been hiking them for quite a while. So this is, I think, the bow on the package. I think the chairman made clear in his press remarks that that this is it, that they expect it to stay where it is. Now, that, of course, is subject to a whole host of caveats because, as you point out, there could be, in fact, quite a number of headwinds that come into play next year. And we are already seeing some of them, and the Fed notes this in its statement. The manufacturing sector is flat. In fact, there's just a report out that shows that for the first time since 29, we are not going to see U.S. manufacturing firms increasing their spending. Right. So the manufacturing sector is flat. A business investment, as you know, stays really quite flat and declining, and that's actually not so good. So there are a number of headwinds, and of course nobody knows about the trade wars, where exactly they're heading. So the uncertainty levels, I think, haven't changed at all. If anything, they have become more severe, and of course this is going to affect long-term growth. We are at a low level of growth.
Right.
This is not the level that was, that certainly, this White House anticipated.
Very quickly, of the uncertainties that are out there, where would you rate trade versus weakness in the global economy?
So it's interesting to separate the two. So the way I kind of look at them is I look at the trade wars as one category of uncertainty, and then of course just the level of low global demand. The level of global demand, that actually we were starting to see that before the on-off switch got played constantly on the trade wars. So we do have both things going on, low levels of demand, and of course these trade wars that are on again, off again, and hard to know when the when the end is.
Indeed. Sarah Bloom Raskin, again, thanks for joining us tonight. Good to see you again.
Good to see you.
A key gauge of inflation showed a slight rise last month. The Consumer Price Index was up 0.3% in November as households paid more for gasoline, healthcare, and rent, and that pushed the rate to its highest level in a year. Now, even though the report shows prices are rising, inflation overall is still considered low historically.
Meanwhile, it was a cautious day on Wall Street. Certainly, stocks seem to like the idea of no interest rate increases next year and the Fed's upbeat view of the economy. But we are one day closer to the new round of tariffs scheduled to take effect on Sunday, and negotiators for the U.S. and China are still working to complete phase one of a deal before that happens. So at the close, small gains only, but gains nonetheless. The Dow average was up just 29 points. We're at 27,911. The NASDAQ added 37. The S&P 500 gained 9.
And trade uncertainty is one of the reasons why chief executives of the nation's biggest companies lowered their outlook for economic growth for the 7th straight quarter. According to the Business Roundtable's quarterly survey, members see growth of 2.1% next year, which is near the Federal Reserve's estimate. While that's a big concern for many companies, CEOs are also quick to point out the strength of the consumer.
The U.S. economy is 2/3, 70% consumer driven. And so if the U.S. consumer is doing well, we know the U.S. economy is going to do pretty well. And so if you look at our spending, just in general, last year to this year, it's up about 5.5% to 6%. And that's across $3 trillion of card usage, of checks written, of cash out of the ATM. So it's a big data set. It's grown faster during the year, picked up a little pace, and that's good news. And if you look at the holiday spending, Wednesday before Thanksgiving to the Cyber Monday, up double digits, strong, and people are spending. And so that's good news for the U.S. economy.
The odds are against a recession occurring before the end of 2020. And what's happened is consumer confidence has really held up. And the year-over-year leading indicators from the Conference Board were at 7% year-over-year 15 months ago, which is really strong. And you have never had a recession in the last several decades without leading indicators first going negative. So that's really the canary in the coal mine.
The consumer sector is certainly strong, and it's offsetting some of the weakness we're seeing in industrial. But globally, when you take a step back, we are in a period of time, I think, where we're seeing slower growth globally. It's not negative, so we still have positive growth, but it's the whole world, we're seeing it as slowing down. And I think the number one question I keep getting is, do you see a recession in 2020? And right now, our data would say probably not.
Now to Washington, where the head of the FAA testified on Capitol Hill today about Boeing's grounded 737 MAX and answered questions from angry lawmakers. Phil LeBeau is in our nation's capital for us tonight.
FAA Administrator Steve Dickson facing tough questions on Capitol Hill, not only about the FAA's decisions when certifying Boeing 737 MAX 2 years ago, but also about what needs to happen in order to lift the grounding of the MAX, which the FAA says will not happen this year.
If you just do the math, it's going to extend into 2020.
So it won't be recertified this year. Do you expect it by the end of January or by the end of February? What would you say is realistic?
It's impossible to say, Phil. I mean, if I had that kind of a crystal ball, I would certainly be able to share it. But it's very important that our team works very closely with the international authorities that have been working with us and with the Boeing team to do this right.
Dickson testified before members of Congress and relatives of those killed in 2 MAX crashes. The message was clear. the FAA must make changes to avoid a repeat of the mistakes made on the MAX.
We are concerned, obviously, about allegations that FAA was a captive of the industry.
Meanwhile, a former Boeing manager who worked at the 737 plant outside Seattle testified the push to ramp up production created an unsafe environment.
Normally when the factory's running fine, everything's going well, but then we had a kind of a cascading problem and it just kind of got out of hand.
This hearing raises fresh questions about the safety of the 737 MAX, but it may not change when this plane returns to service. Boeing is targeting for that to happen early next year, provided the FAA is confident this plane is safe to fly again. Phil LeBeau, Nightly Business Report, Washington.
So what will Boeing have to do to encourage the public to get on the 737 MAX once it is back in the air? With us now is Dan Hill, CEO of the crisis management firm Hill Impact. Welcome, Dan. Nice to have you here.
Thank you. Glad to be here.
It seems to me it's not just Boeing, but the individual airlines are also going to have to do, not rebranding necessarily, but they're going to have to convince the public. How do they do that?
Yeah, that's exactly right. You got to look at who the customer is. And for the customer of Boeing, it's the airlines. And for the airlines, it's the public. And they do have a big task at hand. They have to convince their passengers that they have done enough to certify that this aircraft is ready to return to service. And what Boeing has to do is convince the airlines not only that they fixed the aircraft, but that they have improved their culture and their systems. And that's a challenge that they continue to face.
Well, FAA Commissioner Dixon has said, I mean, we know he's a pilot. He's flown the 737, and he's going to fly it himself. The airline officials have said they will get on the first flight. Are those the kinds of, you know, getting on an airplane is a matter of trust. So getting that trust back is very important. Is that the way to do that? Or what other suggestions do you have?
I think so. I think, you know, first of all, I think that's helpful to Boeing. They're going to want that seal of approval from the regulators and from the airlines. And that is the kind of thing that will go a long way. The public, when you get online and start looking at airfare tickets, you don't generally look at what airplane am I going to fly on. You look at what carriers either offer the best deal or the ones that are the most reliable, safe, have the best customer service. And so those kinds of things will go a long way in terms of allaying fears of those passengers who do care about the safety issue.
What does the airline itself have to do? Say, you know, Southwest has a lot of 737s. Put yourself in Southwest's shoes or another airline's shoes. How do they reach out and reassure the public? What concrete things can they do in case you do have a customer who says, I don't want to take the flight with the 737?
Yeah, I think it's all about communicating what their own process was to go beyond what the FAA is doing, to say this is Southwest Airlines or United Airlines' approach to evaluating the safety. But I also think they want to convince the public that they've pushed Boeing, the manufacturer, very hard to make sure that Boeing has done more than just adjust and fix technical issues, but they have also fixed whatever the cultural issues are that led to this. And that's still a big question out there. Have they addressed those things? Can they detect a problem in the future if it's something else? And will they be transparent about it?
A lot of questions still to be answered. Dan Hill with Hill Impact, thank you very much.
Thank you.
Time to take a look at some of today's upgrades and downgrades. We begin with shares of Cigna. They were downgraded today to underweight from equal weight at Wells Fargo Securities. The analyst says the company's big debt load could hamper growth in the future. Price target $181. That stock rose a fraction to $191.75 today. Meanwhile, Wells Fargo Securities also downgraded Walgreens to equal weight from overweight. The analyst cited pressures on its core business in the near term as well as longer term risks. Price target $61. That stock fell slightly to 58 and a penny today. And Apple's price target was raised to $305 from $275 by Evercore ISI. The analyst sees solid holiday demand for Apple's wearable devices. The firm has an outperform rating on that stock, and shares of Apple rose today to $270.77.
Still ahead, a strong start for Disney's newest product.
UPS was downgraded today to market perform from outperform at BMO Capital Markets, with the analyst expecting that company to have a hard time improving its profitability and free cash flow. But UPS has a plan. It is creating strategic partnerships with companies like CVS to give consumers more of what they want. Frank Holland is in Atlanta for us tonight.
This is one of the 4,600 CVS locations where customers can pick up and drop off UPS packages. Packages at a CVS? Yes. It's called Access Point, a partnership that began in July, designed to increase profitability and volume for UPS, as well as foot traffic and retail sales for CVS. UPS CEO David Abney and CVS CEO Larry Merlo meeting at an Access Point to discuss how they can further leverage the stores that are within 5 miles of most Americans, as well as the growing e-commerce market.
It's really about meeting the unmet needs for our consumers, and this is one of our concept stores that we call the Health Hub, and it's about access, convenience.
Competitors FedEx and Walgreens have a similar partnership that started in 2017. But Abney and Merlo say they don't believe the first movers have an advantage.
What's important to us is to make sure that we take the strengths of both companies and we look to where we can make it a better experience for our customers. If we focus in that regard, then we will have differentiation, and it's the customer that will vote.
UPS and CVS are also both facing disruption from Amazon. The tech giant is expected to increase the amount it self-delivers by more than 50% in 2020. Amazon's pharmacy business that acquired startup PillPack in 2018 is also growing.
Right now, Amazon's market share is very, very low. It may not even be 1% at this point. We think that Amazon has a potential to get a mid to high single-digit market share in prescription drug retailing over the next 5 years or so.
However, Abney and Merlo say they see disruption as a challenge, not a threat. The companies are also partnering on drone delivery of prescriptions and retail goods. Both CEOs see it as another way this partnership could really take off. UPS and CVS plan to turn 1,400 more of these drugstores into Access Point locations in the first half of 2020, bringing the total to 6,000. For Nightly Business Report, I'm Frank Holland in Atlanta.
Move over, Apple. You are no longer the world's most valuable publicly traded company. That is where we begin tonight's market focus. Saudi Aramco made its trading debut on a Saudi exchange, giving it a valuation of more than $1.8 trillion. The majority of Aramco is state-owned, and the Crown Prince who runs it plans to use the money raised in today's IPO to help diversify the country's economy and fund national projects. Shares rose 10% in its first trading session. Home Depot warned today that its sales growth next year will be below consensus estimates. The home improvement retailer says its so-called One Home Depot strategy, which combines its digital and its brick-and-mortar operations, is not generating as much revenue as it had expected. The stock was down more than 1.5% to $212 even. American Eagle Outfitters is forecasting profit and sales for the holiday quarter to come in below market expectations. The teen retailer has been ramping up discounts to counter increased competition and soft demand for its flagship American Eagle brand. The company reported a decline in profit but a rise in sales in the most recent quarter. The shares fell 6.5% to $14.13.
Children's Place reported better than expected earnings, but revenue fell below forecasts, as did its comparable store sales. The retailer also gave a weaker full-year forecast, saying that its bottom line would be hurt by tariffs. Stock lost nearly a quarter of its value today, closing at $54.31. And it was a disappointing quarter for Lululemon. The athletic apparel retailer reported adjusted third-quarter profit that was below Wall Street expectations and said the key holiday quarter, that will also be soft. The company's been increasing discounts to better compete with its rivals. Shares fell in initial after-hours trading tonight after rising in the regular session to close at $233.19.
Disney's CEO Bob Iger has been named Business Person of the Year by Time magazine. The editor cited his accomplishments of the past 12 months, including the closing of the $71 billion Fox acquisition, the opening of 2 Star Wars theme park lands, a record $10 billion in global box office sales, and the launch of its streaming service, Disney+. And today we're learning more about the number of times that the Disney Plus app has been downloaded since it became available just 4 weeks ago. Julia Borston has more.
The first day Disney Plus launched, the app was downloaded 10 million times to mobile devices, desktops, and smart TVs, according to Disney. Now research firm Apptopia is giving us a hint of how the service has fared since then, reporting that Disney Plus has 22 million downloads to mobile devices alone, and Disney Plus has averaged 9.5 million daily active mobile users, ranking #1 in Apple and Google's app stores every day since launch. These numbers only measure mobile use and do not measure use on smart TVs or streaming devices such as Roku and Apple TV. And we don't know how many downloads are 7-day free trials or Verizon Unlimited customers accessing their free year. But there is evidence that Disney's signature app is gaining traction. Apptopia reports the mobile app has generated $20 million in revenue for Disney, a combination of per-month fees and annual contracts. Though Disney Plus's user base is much smaller than Netflix's, which reported more than 60 million U.S. subscribers last quarter, it's notable that on a per-user basis, Apptopia reports Disney had nearly 6% longer average session times than Netflix and nearly 8% longer than Amazon Prime Video. Apptopia says Disney Plus's early success does not yet seem to be hurting mobile downloads or traffic to other streaming services. But Disney Plus is boosting new installs of Hulu and ESPN, which are bundled with Disney Plus at a discount, as well as streaming tool Roku. Disney declined to comment on Apptopia's data. We'll hear its official numbers in the company's fourth quarter earnings report. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And coming up, the pot industry's next chapter.
I'm Jane Wells in Las Vegas at MJ BizCon, the largest marijuana business conference in the world. 2019, a terrible year for legal pot, especially for investors. So what's going to change in 2020? We have that coming up.
Back in 2015, as part of our Bright Ideas series, we told you about a startup called Managed by Q. It's a management platform designed to increase office efficiency, allowing employees to simply schedule cleanings and maintenance and other non-work-related tasks. Earlier this year, we told you that that startup was bought by WeWork, which, as you probably know, has since stumbled. Now, WeWork is reportedly looking to sell Managed by Q to help raise cash and refocus on its main business.
Finally tonight, you know, the marijuana industry was supposed to see exponential growth as more states legalized its use. But it hasn't worked out that way. Many companies have seen their values shrink as they try to navigate a maze of regulations and find elusive solutions. As you saw, Jane Wells is at a cannabis convention in Las Vegas tonight.
And these are 45 plus tax, these are 28 plus tax.
You're looking at one of the bright spots in legal marijuana. A pot superstore in Las Vegas, bigger than a Walmart, doing more than $5 million a month in sales. It's called Planet 13.
We're cash flow positive now. We're very fortunate. We're one of the few companies in the industry, publicly traded companies.
Much of the rest of the legal pot business has not done so well in 2019. The top 6 publicly traded cannabis companies lost a combined $25 billion in market value since the end of March.
I think it's fair to say that 2019, and particularly the slow rollout of retail stores in certain provinces in Canada, caught everybody by surprise.
I would have thought by now that the debt markets would have opened up a little bit more than they have, but because they haven't, companies that have put forth their budgets and their CapEx plans and so forth are forced to use their stock to raise capital, and that's a vicious cycle on the way down at times.
And so here at MJ BizCon in Las Vegas, the largest marijuana business conference in the world, people are hoping 2020 will be better, with better solutions to challenges unique to this industry, like cash.
Cash isn't just king, it's pretty much all there is. Most banks will not let cannabis companies have credit cards because the drug is still illegal at the federal level. That's created an opportunity which a serial entrepreneur now hopes to, well, cash in on.
It's very difficult. Everything in the cannabis industry is about 100 times harder.
Keith McCarty has a long history in tech. Now he's running Wave, a logistics platform which most California cannabis retailers use for online sales and next-day delivery. Now it's partnered with an Arizona financial technology startup called Hyper to create a business-to-business digital payment system for cannabis, using a handful of banks willing to take the plunge, credit unions or state-chartered banks not subject to the same federal rules.
It'd be a lot easier for us to use this also because paying different brands through bank accounts, you risk getting them shut down.
Alex Herrera runs a legal pot shop in Los Angeles called Atrium, and he's going to use the new system.
Do you have a bank account?
Yeah.
Do they know what you're doing?
No.
The hope is that eventually there will be more tools like this to make the cost of doing business safer and even cheaper.
Really, our biggest competitor right now is the illicit market, and we're going after them, and I think that digital payments will really set us apart.
For Nightly Business Report, Jane Wells, Las Vegas.
And before we go, here's another look at the day's final numbers on Wall Street. The Dow was up 29 points. NASDAQ added 37. S&P 500 gained 9. And that is Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.